Good morning and welcome to the Killik and Co market update. We've had interest rate decisions from the UK and the US central banks this week, and both have decided to leave interest rates on hold. Here's a chart showing the base rates in the UK and the US over the last 20 years. Both have come up a lot in the last 2 years, but both have now been left on hold for 2 consecutive meetings. Markets reacted well to these latest interest rate decisions, and in particular, they reacted well to the accompanying commentary, which suggested that interest rates might not need to go up further in future. Here's what the Federal Reserve said. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. Many investors really fixated on this part about cumulative monetary policy, and many thought this was a reference to the fact that US government bond prices have been falling, and as a result, US government bond yields have been rising. A lot of other debt in the US economy is based on government bond yields, and if these have been rising, then servicing other debt will also have become more expensive, and this will have the impact of slowing down the economy and therefore putting downward pressure on inflation. So it makes sense that the Federal Reserve is waiting to see the full impact of this before making further decisions about interest rates. Here in the UK, the Bank of England has published its quarterly monetary policy report, and it contained this chart showing past and predicted inflation and what has contributed to that inflation. Petrol prices and energy bills are shown in the orange, and you can see that these have previously had a significant positive impact on inflation, but the bank is expecting them to have a negative impact in future. So this will be a key reason why the Bank of England has decided to leave interest rates on hold. Apple reported results yesterday, and the shares dropped by over 3% in after-hours trading, leaving the shares over 13% below their peak. Revenue from China came in below expectations, and the company received a lot of questions about China in the earnings conference call that it hosted after publishing these results. Apple is still heavily exposed to China, firstly in terms of its supply chain and where it makes its products, and secondly in terms of where it earns revenues. Here's a breakdown of Apple's revenue by region, and you can see that 19% came from China in the last year. In the conference call, Chief Executive Tim Cook said, "I view China as an incredibly important market, and I'm very optimistic about it." And this is a statement that puts him at odds with other companies who are trying to reduce their exposure to China. Also this week, we had a trading update from Next, which is not covered by the Killik & Co research team, but the update did contain a very interesting chart that will have some read across for other retailers. We often hear clothing retailers complaining about the impact of the weather on their sales, particularly when the weather is warmer than expected, and that tends to mean that the retailers don't sell as much warm clothing, which is more expensive than summer clothing. The chart shows the variance in Next sales by week in comparison to the previous year, and above that it shows what the weather was doing at the time, so you can clearly see that sales are higher when the weather is cooler than expected, and the sales are lower when it's warmer than expected. Moving on to have a look at next week, we have got results due out from Disney, Airbus and Deutsche Telekom. That's it from us. Have a great weekend, and we look forward to seeing you next Friday.